Good day, my name is Sashley Root. I'm a student at Northwest University studying towards a BCom in forensic accounting. This video is for the purposes of a group project that we have to do this semester, and I hope you enjoy. Basic concepts of bookkeeping for women. This presentation will show the statistics, course information, and basic accounting information to help women enter into the finance sector. What will be covered in our video today is statistics in the finance sector, theory for bookkeeping, basic journal and ledger entries, the financial statements, and courses available and the information required about these courses. And at the end of the video is our resources used in today's presentation. Statistics of women in the finance sector. It has been noted that there is a large gender inequality in the finance sector. The finance sector has had a 30% higher pay gap than non-finance sectors until 2017. Women are less likely to receive equal pay in businesses that are dominated by male culture. 51% of employees in the finance sector are men. Finance firms have less women a part of their management teams, as well as operate in regions of a less female-friendly culture compared to the non-finance sectors. In the UK, men have a higher pay wage than women, which is seen with €29 versus €17. In figure 3 below, it is shown the female and male representation in managerial and professional occupations over the time, and we can significantly see that the gap and the dominance is a lot higher in the finance sector than in the non-finance sector. Theory of bookkeeping. In order to continue, we need to understand the basics of accounting. So what is the purpose of accounting? The purpose of accounting is to communicate financial information to assist with decision making for those users of the financial statements. It also shows the economic activities of a business, and it ensures that regulations are met by the business. We get different types of users that use the accounting records. We have external users, which are people who look at the financial statements from an outside perspective. These are, for example, creditors, investors, customers, community, and the state. Creditors need to ensure that you are able as a business to pay back the debts you have acquired. Investors would like to see if they would get a good return if they invest in the company, and customers, community, and the state would like to see that you are not just operating on profit, but to also help benefit the community and the country in general. Internal users are people like employees and management to ensure that they are doing their jobs effectively and doing what is required of them to ensure that profit is made and they are going over all regulations required. Definitions. We have assets, which are economic resources that are controlled by the entity due to a past event. We have liabilities, which is a present obligation of a business to transfer an economic resource due to a past event. We have equity, which is the residual interest in the assets after liabilities have been deducted. Income is an increase in assets or a decrease in liabilities, and expenses is an increase in liabilities or decrease in assets. We get different types of entities. So we have a sole trader, which is only one owner. We have a partnership, which ranges between 2 to 20 owners. We have a public company, which is an unlimited amount of owners, as you can have shares being traded on the JSE. And we have a private company, which consists of 1 to 50 owners. Then, with accounting and the preparation of all accounting records and financial statements, we need to comply with the conceptual framework. Now, the purpose of the conceptual framework is to ensure that there are limited differences in the preparation of financial statements from different entities. This allows users to compare financial statements from different entities and be able to understand them. We have different aspects of the conceptual framework which needs to be considered whilst preparing the financial statements. These are the underlying assumptions, which is the going concern principle and the accrual basis. The going concern principle works on the concept that Financial statements should be prepared on the basis that the business will continue in the future, unless there is evidence to stipulate that the business will not continue. That is when financial statements are prepared on the liquidation basis. The accrual basis works on the concept that financial statements are prepared when income and expenses are incurred and not when cash flow takes place. Fundamental and enhancing qualitative characteristics works on how the financial statements should be presented. They should be fairly presented and relevant. They should be timeliness, and they must be comparable and understandable for the users to use the financial statements. The accounting process. So the accounting process is a very basic process that we can easily understand and get the flow of the process going. So the first step is transactions take place and are recorded in the required journals. Then general ledgers are prepared from the journals and posted to the general ledger. A pre-adjustment trial balance is prepared, and adjustments are recorded once there are differences and we can see that adjustments need to be made. And once those adjustments have been made, a post-closing trial balance can be created. Finally, the preparation of financial statements takes place using the post-closing trial balance of financial statements. So we have four main financial statements, being the statement of profit or loss and other comprehensive income, statement of cash flow, statement of financial position, and statement of changes in equity. And then we have subsidiary notes, which is additional information to the financial statements to allow financial users to gain more information on the relevant information that is in the financial statements. So the statement of profit or loss and other comprehensive income shows the financial performance of the business for a specific period. The statement of cash flow, it provides information for the changes of financial position by assessing investing, financing, and operating activities. This shows the way the business inquires and distributes their cash and cash equivalents. Statement of financial position. This shows the economic resources of the entity and it portrays the liquidity and solvency of the business. Statement of changes in equity. This provides the capital transactions, dividends paid, and any other transactions made to distribute to the owners. This shows the change in structure of the company's equity. The notes are used to create a better understanding and eliminate uncertainty of financial statements. Basic journal and ledger entries. These are examples of journals, for example, a cash payments journal, a cash receipts journal, a debtors journal, and a creditors journal. This is where we put the transactions that took place throughout the year. So as we can see in such examples, we have the document number, the dates, and the relevant amounts and which category they fall under, whether it's purchases, creditors control, or whether it's sales or credit sales being a debtors journal, or a credit purchase being creditors going into the creditors journal. This is to ensure that every transaction can be seen and recorded before creating our financial statements. This is the first step after a transaction takes place. We have to record the relevant descriptions of debtors or creditors or whichever company that we are purchasing from. And the totals of the journals then get posted to the general ledger. Basic concepts of ledger entries. So the three basic ways of how to record the totals of your journals into the ledgers is that assets, if it is an increase, it increases on the debit side and decreases on the credit side. With liabilities, it decreases on the debit side but increases on the credit side. Equity decreases on the debit side and increases on the credit side, like liabilities. But if an income decreases, that goes on the debit side. And if an income is received, it goes on the credit side. If an expense is increased, that is on the debit side. And if an expense is decreased, it goes on the credit side. So such examples, for example, an asset, if we purchase a piece of equipment, the equipment ledger will increase with the amount on the debit side, but then the bank, which is also an asset, decreases on the credit side as we had to pay an amount of money in order to receive the equipment. Liabilities, if we buy stock from a creditor, we haven't paid them yet. Therefore, we are liable to pay them the money back for the stock that we received. Therefore, the creditor's account, which is a liability, will increase on the credit side. Once we have paid the creditor, we will decrease their creditor's ledger account with the amount that we paid back to them. Equity, if we have income such as rent, we rent out a building, the income received from the rent will go on the credit side of the rent income ledger. And if we have to pay rent, it will go on the debit side of rent expense. Here are examples of general ledger accounts. Each account has their own general ledger, and this can be seen with capital, bank, office and furniture equipment, long-term loan, creditors control, and stationery. Now we work on the double entry principle, which means for every debit there must be a credit. And this can be seen, for example, with bank, we had capital, which means the owner paid money into the bank account of the business. So therefore, because bank is an asset, it increases on the debit side. If we go to the capital general ledger, we can see bank with an increase of the same amount on the credit side. This is the double entry principle. For every debit, there must be a credit. So another example can be on bank, on the credit side, we have creditors control. This means that the business paid a creditor back the money we owed them. Therefore, bank decreases as money went out of our account to pay the creditor, therefore it's on the credit side. If we go to creditors control, which is a liability, we can see on the debit side there is bank for the same amount because the account of the creditor decreased by the amount we paid on that date. Financial statements. So financial statements. The presentation. Financial statements need to be fairly presented and be accurate. The presentation and disclosure of financial statements needs to be in terms of IFRS, which is the International Financial Recording Standards. The process. After the general ledgers have been prepared, the closing balances of each general ledger is transferred to a trial balance. Then adjustments are made for any information that has been omitted or incorrectly posted. After the adjustments, a post-closing trial balance is prepared, which is used for the financial statements to be prepared. You have 6 months to prepare the financial statements after year end, otherwise, any time after 6 months becomes redundant. Examples of financial statements. So, as seen below, we can see an example of the statement of financial position and the statement of cash flow, which has been taken from a textbook that we are currently using in our first year, which is Accounting and Introduction, published by Myberg. As we can see, in the statement of financial position, we have 3 categories, being assets, liabilities, and equity. Liability and equity are grouped together as the total of equity and liability must equal the total of your assets. Are divided into 2 categories, non-current assets and current assets. Non-current assets are assets that are not primarily used for trading in the business. Examples of these are property, plant, and equipment, which is land and buildings, office equipment, vehicles, etc. Current assets are primarily used for the trading in the business, and these are not longer than 12 months. For example, inventory, which is any type of stock that is required in trading, whether it's retail or service. Cash and cash equivalents is your bank and your cash available, for example, petty cash is another example of cash and cash equivalents. Current assets or trade and other receivables are things like your debtors. Debtors are not supposed to last longer than 12 months. you are supposed to receive the money within the 12 months of trading. Equity and liability. Equity consists of your capital, which in a sole trader is drawings and capital, whereas in companies it can be share capital, which can differentiate between ordinary shares, preference shares, etc. Current liabilities. So liabilities are also divided into two separate categories, being non-current liabilities and current liabilities. Non-current liabilities being longer than 12 months. Examples of this are mortgage loans, which are paid over numerous amounts of years rather than within the 12 months of the financial year, whereas current liabilities are within the financial year, such as creditors. Creditors should be paid within the 12-month period. The statement of cash flow. In the statement of cash flow, we get three different categories as well, which is your operating activities, your investing activities, and financing activities. Operating activities works on the activities that happen within the operation, such as profit before tax, which is what you calculate in your income statement, and then adjusted because the cash flow statement works on the flow of cash and how the business uses their cash flow. We have to deduct things that are non-cash items. For example, depreciation is not an actual cash item, but it is a depreciable amount on assets. Therefore, there is no cash being transferred, so we have to deduct that or add it back rather. Loss on a sale of asset, profit on a sale of assets, as these are not actual cash amounts. The total amount received for the sale of an asset is the cash flow amount, not the profit made on the sale of that asset. Working capital refers to the change that encounters in these subcategories, the subcategories being inventory, trade and other receivables, and trade and other payables. If there is an increase in inventory, it means it was an outflow of cash as we had to pay to receive the increase of inventory. If it is a decrease in inventory, it means there is an inflow of cash because customers have paid to get the inventory that we sell. An increase in trade and other receivables means that there was an outflow of cash due to the fact that debtors have not yet paid for the goods they have received from us, but they did receive those goods. If there is a decrease in trade and other receivables, it means that there was an inflow of cash as the debtors have paid back their debts for what they have received. A decrease in trade and other payables means there was an outflow of cash as we paid creditors the money we owe them. If there is an increase in trade and other payables, it means that it is a cash inflow as we have not yet paid the creditors, but we did receive more goods from them. Investing activities refers to the business's activities of investment. This means purchasing land and buildings, purchasing equipment, and so forth. So if there is an increase in investing activities, it means we purchased more assets. This means that money went out of the account, therefore it is a cash outflow. If there is a decrease in investing activities, this means that there was a cash inflow as we received money for the sale of assets. Financing activities refers to loans and shares. This means that if there was an increase in a loan, that means it's a cash inflow as we received the loan amount that was requested but have not yet paid the payments for the loan. If there was a decrease in the loan amount, that means we have paid portions of the loan back, which furthermore leads to an outflow of cash. With regards to shares, if there was an increase in shares, that means that the business has received cash and money for those shares that were available. If there is a decrease in shares, it means that we had purchased shares back for the business to own, meaning cash flow was an outflow. Statement of profit or loss and other comprehensive income. Statement of profit or loss and other comprehensive income shows all our income and expenses of the business. So in the examples below, which was extracted from our textbook as mentioned earlier, we can see that it is divided into our income and our expenses. At the top, you will normally, if it is a retail company, you will have revenue and cost of sales, gross profit, and then your other income, and then your expenses. If it is a service company, then it will be revenue without cost of sales, as it is a service company. Income can be commission income, rent income, profit on the sale of an asset, etc., etc. Expenses can be things like water and electricity, rent, um, interest expense, which is a finance cost, and then we get interest income, which is a separate line item of other income, which appears after the expenses in our statement of profit or loss. Other comprehensive income refers to reevaluations of buildings and so forth. Statement of changes in equity. With statement of profit or loss, at the end of the statement, we find our net profit, which, if a company is large enough to pay income tax, we first get our profit before tax, our tax expense, and then our net profit for the year. Statement of changes in equity. This refers to the change in the equity. So this for a company would be dividends that was paid or shares that were issued, and that is our changes in equity. With regards to a sole trader and a partnership, it will only be things like capital and drawings. Course information. The following with the course information is courses available in South Africa that women can use to further their financial skills in order to go into the financial sector and develop more women into the financial sector so that we do not have such a high gender inequality in the finance sector. University of Cape Town Bookkeeping online short courses. This course is cost effective and is only 9 weeks long, excluding orientation. The perks of this course is that it is online and only requires 7 to 10 hours of working a week, allowing you to continue with other jobs or other personal requirements whilst furthering your skills in the financial sector. This course comprises of 9 modules which are worked through on a weekly basis. The modules cover the basics of bookkeeping, inventory control, value-added tax, journals, the general ledger, debtors, creditors, reconciliations, returns, and salaries and wages. This ensures a well-rounded skill and understanding of bookkeeping to enter into the business. And this was found on the UCT Bookkeeping online short course website. Udemy online course. This course is ideal if there are limited funds in furthering your skills if you have a busy schedule. The cost of this course is only R1,999.99. This course is exclusively online and works on a self-dedicated learning basis. This means that you have access to the lecture videos for as long as possible and can complete the course whenever you have time. There are assignments available, and one article must be completed before receiving a certificate of completion. The course offers understanding of basic accounting concepts, accounting terminology, accounting fundamentals, auditing processes, forecasting and budgeting, internal internal controls, interpreting financial statements, balance sheets, income statements, statement of cash flow, inventory accounting and cost accounting, and so much more. South African College of Business. This is an ICB financial accounting intermediate level with the subjects of business law and accounting control. This course ensures completion for skills in for skills of accounting technicians, which includes the study of economics, business law, and accounting controls, liquidations, and executors' accounts. All that is a prerequisite for this course is that you completed your grade 12 and that you had accounting as a subject. This certificate of completion gets you one step closer to a national qualification, and this course can be completed within 3 months. This course includes assessments, tests, and final exam to ensure an adequate completion of the course. I recommend doing these courses as it allows you to further your education and your knowledge in the finance sector, especially in accounting, and this allows you to take that one step further into business and become a very important role in businesses itself. The perks of these courses is that you are able to do them online, there's no rush to complete them, they are cost effective, and you can be qualified in the end. I think this is very good for women, as with busy schedules and money constraints, these are very effective, and this can help curb the gender inequality. The resources that we used in this presentation today. The resources, our first resource is an academic article that was used for the statistics of gender inequality in the finance sector and the non-finance sectors. Myberg, the accounting and introduction, is the sources for all the examples of the financial statements, journal entries, and ledger entries. The completion of Introduction and Finance is the link for the Udemy course. SACOB is the resource that is available and the website that is available to encounter the course contributed by SACOB. Thank you so much. I hope you enjoyed the presentation.